Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today, Dan talks with David Cervantes, founder of Pinebrook Capital Management.
And Corey and I have to talk about all kinds of stuff. Sam Bankman-Fried, WeWork, bond yields, and some kind of depressing stuff about the economy.
That's true, but we're okay. And remember, if you want to ask us a question or tell us what's on your mind, email us at feedback@investorhour.com.
That and more right now on the Stansberry Investor Hour. It turns out you're not allowed to commit fraud. You're not allowed to take people's money and do all kinds of other stuff that you didn't tell them you were going to do with it. And Sam Bankman-Fried has been convicted of fraud in the New York court system. It's official.
It is official. And you know what's interesting about it? Bitcoin's hasn't been better in the last year, the price. But I've been thinking of these headlines in my mind, comical ones, Bitcoin at 18-month highs on Sam Bankman-Fried going to jail. But no, that's not it. But yes, he was convicted, and finally this part of the story is over. But yeah, just shows you he was who we thought he was, right? When all this stuff started happening, we were wondering what was going on, and it kept getting worse and worse and worse. And so it was.
Yep. And I remember, I was saying that I didn't necessarily think he was fraudulent, but I just thought he was so dizzy and incompetent and spaced out and just so egregiously incompetent. He never should have been running a company. And that was his persona. He was definitely putting that out. He said, "Oh, I screwed up, and I'm so sorry, and it's terrible. I feel terrible. I'm trying to make it up to people, blah, blah, blah." The courts, the jury, whoever, did not buy it. Nobody bought it. They said, nope. You weren't just incompetent. You were fraudulent.
Right. Yeah. And it's funny you bring that up, because I haven't been paying super close attention to this trial, just because I figured he'd be found guilty, no matter what. But from what I had heard, the prosecution got to that very point was they laid out 6 very specific instances where he was caught lying and then deliberately doubled down on that specific part of the lie and that part of the fraud. And so they showed it it was all done deliberately, and he wasn't just a dumb crypto bro. He was, he knew what he was doing. So no offense to any dumb crypto bros out there or anything like that.
Yeah, that's right. Yeah, no offense to dumb crypto bros everywhere. Well, the crypto market seems to love it. Oh, thank God Sam's gone. We can trade again. We can we can run Bitcoin up again.
Yeah, I do think there is something to be said for that. Okay, this is taking care of this fraud story.
Yeah,
all right, we have our big crypto fraud that went public and mainstream. Maybe we can get past this. So
you're right. There is a serious point. This doesn't taint all of crypto. It certainly doesn't taint Bitcoin or Ethereum or whatever you like. It's just this one person's activity, and it doesn't screw up the whole market. So, most frauds don't, even if they seem to at first. But I just think that this is just, it's another typical sign of what you get after decades of declining interest rates and then more than a decade of 5,000-year low interest rates. You get all kinds of crazy stuff that has to work its way out. Another thing that appears to be working itself out is WeWork. WeWork, the co-working company, the company that leased buildings for 10 and 20 years and then turned around and tried to find clients who would occupy space in them for as little as 1 month. The co-working business model, there are companies that do it. There's a company named Regus, R-E-G-U-S, that does it. So it's not necessarily a terrible model, but this company never had anything but operating losses, and they took in tens of billions of investor capital and lit it all on fire. And now the Wall Street Journal is reporting that, its sources are saying that they're preparing a bankruptcy filing as early as next week. So they missed a bond payment. that kicked in a 30-day grace period. They negotiated an extra 7 days, and I'm pretty sure the 7 days are up next week. So depending on how much more the bondholders want to put up with this, basically, they will be filing probably pretty soon. Not a big surprise.
So the free beer and the nice furniture didn't do it. It wasn't enough for WeWork.
That's right. Yeah, the glass and brick and free beer in the buildings and stuff. And if you go and you look through the timeline, I was looking back through some of this. There was a point where the headlines all said, "No more free beer at WeWork," because they were losing money and losing and losing and losing, and they had to cut somewhere, so they cut the free beer and wine from the
I
break
imagine that
rooms. Or
maybe this. I don't know if you saw anything on this. This just came to mind, like the timing of this. Like, I wonder if the push to going back to the office has anything to do with this, from different companies and whatnot. Because they're a
right.
Office sharing space essentially, or were.
Sure. So classic. Yeah. I agree that I think that's actually, I hadn't thought of it, and I think it's a kind of a brilliant observation that this could be the sort of moment of capitulation in the office space, right? The crappiest co-working company, the crappiest deal in the whole space is finally going bankrupt. And that will, that's the final washout in the office space. And I know that certainly our parent company has said, "Hey, we'd like to see you guys back in the office." They're not going to see me because I live 3,000 miles away, but I will be there visiting more often, much more often than I have been. So you will see me there, just won't be commuting every day.
Yeah, well, that's good. Yeah, I mean, there's something to be said for people actually seeing each other and getting things done that way, as opposed to this virtual world where you're pretending things don't exist necessarily. You're pretending more things don't exist in real life than they do. So, at least from my view. Yeah. So anyway, that if that's something that is significant in this WeWork story, then it is. But maybe it's also a sign of if that is true, of trouble in the office space in general. Moving ahead, if I don't know, 50% of companies or whatever don't say, hey, we're going remote, like for the next 5 years or whatever, we'll try it. I don't know. Could be just something to think about. I know it's all been out there, the commercial real estate market, that discussion for a while.
Yeah, it has, and it's been ongoing, and of course, COVID just obliterated an already developing trend and just, cranked it up to 11. And now we will see. Now we will see if the washout has been sufficient and if this really is a sign that, the distressed types, like we have a stock in Extreme Value that is just loaded up with cash, and I think they still might own one or two office buildings, having sold almost all of them. So it's paid out some of its cash, but it's got lots of capital. It's ready. And these are some of the greatest real estate investors of the past, decade, century even. So if there's a truly attractive opportunity and the risk reward is right, I bet those guys will find it before anybody. And now I'll be looking for it. I haven't even thought about that stock. We just sort of update the price and dividends or whatever, and we don't think about it. But now we'll be thinking about it. Now that WeWork appears to be going bankrupt, when they actually file, I'll think to myself, okay, are there any, leases to take over or buildings to buy? Because I think they do own, they might still own some, but they mostly lease overwhelmingly. We'll see. It's an interesting thought. I hadn't really entertained that. I was just entertained by WeWork, period, because, they released, when they released their initial filing document in 2019, and, in their failed IPO attempt, it started out by saying something about, "This is dedicated to the energy of we." The energy of we, and their mission statement was to elevate the world's consciousness. It's just, the whole thing has generated lots of fodder for the Stansberry Digest, as you know. you know, so I've been entertained by it, but I have not really thought about office space seriously until you just mentioned that. So thank you.
Well, you're welcome. And thank you for the entertaining commentary on WeWork. It sounds like a religion. I didn't know about that,
It
the
does.
culture of we.
Yeah.
Yeah, I wonder if...
the energy
yeah.
of we. Yeah.
Oh, the energy of we. Okay.
Yes.
Well, it's surprising to me that I would have thought they would have filed for bankruptcy already. I mean,
oh yeah.
but I guess the fact that they haven't also tells you something about this environment in general. That there's
Yep.
probably a lot more bankruptcies to come from actual, if the environment stays tough, from actual, decent companies.
Well, yeah. Bankruptcies are up this year. They're almost, and in the first 3 quarters of this year, we're like 2 or 3 bankruptcies shy of the total for 2020 in the first 9 months of 2020. And then it's going back to like 2010 or 11 or something. It hasn't been that high. So bankruptcies are definitely ticking up. And, the companies like Yellow, the trucking company, and, Bed Bath and Beyond. I mean, there's 15 or maybe 17 of them with more than $1 billion in liabilities so far this year. 17 bankruptcies with more than $1 billion. So wow, right? I mean,
Yeah.
they're fair size bankruptcies, and I think you're right. We're probably going to see more of them. And it's totally, when you go from like abnormally low rates, which WeWork was totally a product of abnormally low rates. It was founded in 2010, 2 years after they pushed the Fed funds down to zero. And the market was, recovering and everybody was feeling a little better. And then these guys came in.
Yeah. So they had the full QE, runway. They had the full, the full thing. Yeah. There's probably no perfect story, right? Yeah.
Perfect. Yeah. 2 years of tailwind and then the full QE runway ahead of them. And they did it. And their founder was just like, I don't even know how. It's eccentric, doesn't even cover it. The guy's like smoking weed, drinking tequila, said he was going to be the world's first trillionaire. He said he wanted to be the president of the world, like I think with a straight face.
Interesting. I guess you have to be elected president of the world, or you just decide you're the president of the world.
I think so.
Yeah. Well, I mean, this also reminds me of you. When we're talking about the economy in general, like you've written a lot of recently, a lot of notable investors, big names that you would recognize, like Stanley Druckenmiller, Bill Gross, have been kind of sounding the alarm on the economy as well, right? I mean, you wrote about this detail the last week or 2 weeks ago.
Yeah, and boy, I'll tell you what, they did it just in time for bonds to start ripping. And I actually got long a little bit in options on bonds, and they're outperforming and I did some call options on bonds and a little bit on equities, and the bonds are like out ripping the equities. I mean, they're just really have done extraordinarily well. And of course, like the 10-year Treasury yield, it hit 5%, and now if you looked at a chart of it, it was like boom, from 5%, wham, back down to like 4.5.
It's a big move in a little bit of time. From
very little bit, yeah.
From what I was writing about last week was, we had the Fed meeting where they stood pat, which we thought was going to happen, and then the Treasury Department got some attention over their plans to practically fund the government by not increasing the amount of bond issuance by as much as they had previously said. It was by $1 billion in I think 10-year and 30 years, which less of an increase in issuance for this upcoming quarter than what they were saying. And so I think that kind of gave a jolt to bonds as well. And I just wonder, though, is that short-lived? Is for on the longer end, and I don't know, how long can that last or not? Have we seen the peak in the longer-term rates? I don't know, but it seems like we could, but I'm not totally convinced yet.
Yeah, I'm not convinced of that at all. I don't hear, no matter what Jerome Powell said at the press conference on Wednesday, and in the statement, I don't see them cutting. Maybe they won't hike anymore, maybe, and that's a big maybe, but I don't see them cutting. And, I even have my little, FOMC statement analysis tool, and it actually came out slightly more hawkish than the previous one, um, just solely because of one single word in the thing. I found one single word more hawkish, which was the very first sentence of the previous statement in September was, "Recent indicators suggest that economic activity has been expanding at a solid pace." Emphasize the word solid. And then the new statement, on November 1st, "Recent indicators suggest that economic activity expanded at a strong pace in the third quarter." I called the solid pace statement neutral, and I called this one hawkish. Going from solid, I think solid is just doesn't communicate it as much as strong. I could be wrong. I could be totally
No,
off.
I think the same thing. It was when you look at, I took that as a reference to the GDP number from the third quarter.
Mhm,
It was almost
mhm.
5%, which if you have GDP of 5%, inflation it's still at almost 4% by the Fed's preferred measure. I mean, what that's not a cut
Yeah,
rate environment anytime soon. So, um,
no,
yeah, I'm with you there.
right. If GDP weakens, maybe things will be a little different, which I think is not out of the question at all. It wouldn't surprise me if they revise that big number downward later on, because that's just the way things go. And then we'll see. Then we'll see about, but I've said all along that I thought things had changed and that the bias was now higher for longer. It wasn't the old bias from Alan Greenspan to Ben Bernanke, where they were biased to ease and to lower rates. I thought, well, I think this has changed, and Jerome wants to be the guy who stopped inflation. So we will see, if we do get a downward revision and we do get a lower GDP number, and stocks have come up too a little bit lately. But if bonds continue to sort of go up and kind of discount a slower economy, then we'll see. And if unemployment, ticks up, which it did recently, if that continues happening, then we'll see. And we'll see if Dan's right about Jerome's resolve to be the guy who stopped inflation instead of saying, "Oh, I can't do this. I got to cut."
Right, right. Yeah, well, I'm totally with you on that point too. I think the short answer to all of this is just more higher inflation for longer. Higher inflation for longer is where my head's at with all of this until further notice, until something changes that. And I say there's tons of risks for more inflation and very few, I think, to like deflation right now. I mean, that may happen, but right now it's um, from Fed land. It seems like higher rate, keep rates where they are, inflation go to steady. But what we keep forgetting is the Fed keeps saying they won't get to 2% inflation until 2026, and like this is not. They're not. That's what are we 2 years from now? And so they're just banking on these numbers, like slowly, kind of like their balance sheet, just kind of running off on these base effects and just getting down to normal average eventually. That's what they're banking on, and I think we forget that. And so they're just going to keep rates where they are until, or raise them if they need to, until anything else.
Yep, and I agree, and that's why, among other things, I think long-term tips with, real yields north of 2%, which like hardly ever happens, are pretty gosh darned attractive. Bob Elliott, who we had on the show, former Bridgewater guy at Unlimited Funds now, he's got a whole thread on Twitter about this, and I just thought, I responded to it. I said, "Sold, I'll take them," because it's they're treasuries. I mean, it's treasury and inflation protected securities. Inflation protected treasury bonds. It's like, wow, okay, that's hard to beat when they're real yield of 2.5. Um, you're lucky to get any real yield in the past several years here.
Yeah.
So 2.5 is like, whoa, yeah.
Party on.
Yeah, so that's good. I mean, we're still in, income is back, investing is back. There's a real benchmark, all that stuff that I've said before. But it's a pretty good move here recently. The 10-year losing like 50 basis points off the yield just like that. Just like boom, gone.
Yeah, I mean, I've done some reading on the Treasury market too recently, and just because of the volatility in it, like the last 6 months, a year, it turns out there's like 10% of Treasury holders are hedge funds now, just trading them, and central bank, percentage has gone down to like 50% of holdings. It's so the Treasury market is now it's always been a liquid market, but now it's being treated like Bitcoin. We're trading, the hedge funds are really amping up their exposure to it. So I think we'll see some of these moves higher, lower, whatever the volatility as we, as all this uncertainty around the Fed and rates and the economy continues for at least the next little while.
Yeah, I would suspect that, the markets are going to act the way they always do, and people will be sucked in. They'll say, "Oh, it's a new bull market in equities. Oh, and look, bonds are coming along for the ride," and we're back to where we were, and you can do everything you used to be able to do. 60/40 is great, whatever. And I just don't think that is in the cards at all. I think a lot of people are going to get whipsawed, and a lot of traders are going to leave the market in the next year. I think the next year is going to be really super difficult. I think 2024, I titled my presentation in Las Vegas a couple weeks ago, you know, 2024, the worst year since 1932, just because that was like super high unemployment, and one of the worst mega bubbles burst, and worst bear market bottomed in July of 32. And other things happened too, like, the Lindbergh baby kidnapping and murder. And it was just, it was a bad feeling in the country. I'm really afraid that we're going to get a year like that. And I think it's within the next, couple here.
Yeah, unfortunately, I'm there too because of geopolitics and
Mm.
inflation, and it's all coming to a head this year. I wrote a digest a couple weeks ago to this point about the wealth gap in the country, and I've got it's the most comments I've gotten on anything I've written in a while about are you okay, man? That was pretty grim what you're what you're talking about. I was like, well, I mean, personally, I'm like semi okay, but when you look out at the economic environment and culturally, I mean, things are crazy. It's not over yet. I don't think we've gotten to a breaking point yet, unfortunately.
No, and that,
So I'm with you on that.
yeah,
Yeah.
that wealth inequality, that just in the unwinding of low rates, that just gets amplified, right? Because when everybody seems to be pretty okay, it's happening, but nobody's complaining about it. But then when, treasuries lose 30% of their value, and the economy, starts behaving poorly, which I expect that it will, then the inequality becomes a big problem. And then you get like actual violence in the streets. And I have to admit, I do fear that in the back of my mind, and I'm very happy to live in a small town, hours drive away from anything like a big city, really. Um, we'll see. Let's maybe we shouldn't go too deep into this. We don't want to be that kind of a show.
Yeah. Let's save that for another time.
Yeah. All right. But we won't save for another time our interview, which is actually a conversation that I had with a previous guest named David Cervantes of Pinebrook Capital. David and I had a really interesting conversation about a topic that's been in the news quite a bit lately, and he has some very definite ideas about it. It's the weight loss drugs and their impact on the global economy. And when he first told me about it, several weeks ago, like months ago even, I hadn't heard a word about it. So he was sort of on this before other people were, and now it's become a big headline grabbing issue. So we're going to replay the conversation I had with David Cervantes during the Stansberry conference just a couple weeks ago in Vegas, and really give a listen to what he has to say. It's very interesting. So let's do that right now. The Fed wants you to believe they've got inflation under control, but I believe we've only seen the beginning of a devastating new crisis. And if you don't prepare now, you could see your savings evaporate as inflation and interest rates soar even higher over the next 2 years. It all traces back to a golden thread that ties together the biggest financial calamities in America's history. But it seems the entire financial world is falling into this very same denial trap that led to massive devastation the last time this crisis played out. If you know your history, you know there will be winners and losers, and now is when you decide which one you'll be. I've spelled it all out in an urgent new report. Go to www.bankrun2023.com to get your free copy. I'll also show you how to get my complete playbook for navigating this crisis, including the 3 critical steps to take immediately. Again, that's www.bankrun2023.com for your free copy of my new report. Please help me welcome David Cervantes. All right. Now, I understand you have some slides and some things that you want to tell us. Maybe we'll just get started with that, and you and I will have a little conversation as we go along here. This thesis that David presented to me, you may have heard about it in the news, but when he told me, a month or so ago?
About 2 months ago.
2 months ago. I had never heard a word about it, and it's pretty big, to say the least.
Yeah, it's a funny story. I was on vacation in Copenhagen and came across a news headline that as a result of these new weight loss drugs, the GDP would have otherwise been negative 1%, was actually raised by 2% to hit a 1% positive, just on the sales of these 2 weight loss drugs. So I'll just run over a couple of big topics, let you know where we're going, and go from there. So, obesity is a huge problem. It's not just an American thing. It's everywhere. Not just a developed world problem, but a developing world problem as well. There's a huge macro cost associated with this, not just in terms of funding and paying for treatment, but there's also a loss of productivity and a drag on GDP growth rates.
Except in Denmark.
Except in Denmark, yeah, because everybody rides a bike. But so we have these GLP drugs, and I'll go into what this really is. Mm-hmm. But medical science has effectively delivered us a potential game changer that could have a massive impact on the macroeconomic landscape, not just in terms of how much we spend on healthcare, but in terms of future growth rates and also sustainability of our budget deficits and our healthcare system, which are basically spiraling out of control at this point.
Yeah, so bigger than AI is what David told me when we were talking out in the hallway.
So just to give you no pun intended on the scale factor, but half the population in 34 out of 36 OECD countries is overweight. 1 in 4 persons is obese. In the United States, that number is 42%.
42%, wow.
Is already currently obese. Obesity is responsible for 70% of all treatment costs associated with diabetes, 23% of all costs associated with cardiovascular disease, and 9% of cancers. So this is a huge, huge thing. A little more perspective on scale. The U.S. spends around 18% of its GDP on healthcare. That's around $4 trillion. Of that $4 trillion, roughly $600 billion is obesity related.
I didn't put this together before, but cancer and cardiovascular, aren't they the 2 big killers in the United States? Like more people die of those 2 things than anything else.
Correct. But the link with obesity and cancer is less than with cardiovascular.
Okay.
But to your point, absolutely correct.
But there, yeah.
So this is a projection here by the OECD. Between now and 2050, obesity will drag U.S. GDP down by about 4% a year.
Wow.
I mean, this is bonkers. This is more than what we spend on defense.
It makes me wonder how.
simply by what? Medical costs must be the main thing.
There's medical costs. There's absenteeism from work. There's people getting out of the workforce earlier. People getting on disability sooner.
Okay.
It's a black hole of
I
problems.
see. So it's a hit to productivity, among other things.
There's over 236 medical ailments associated with obesity. I mean, it is just, it's really the root cause. If we could just fix this, we are on a whole different plane of economic development.
Okay, I believe you.
So, yeah, I already mentioned some of these stats. Just also the growth in the epidemic. One I didn't mention in these slides is in 1974, the year after I was born, 12% of the US population was obese. And then by 1999, it was 30.5%. By 2020, now it's 42%. So this thing is just going parabolic. It's nonstop.
So all those internet memes showing pictures of people at the beach in the 70s next to people at the beach in the modern era, they're true.
Correct. They're also smoking. But they're definitely true.
All right.
So yeah, it's a huge thing. And again, it's not just the United States. This is a global phenomenon. I mean, I lived in Europe when I was studying abroad as a student back in the 90s, and it wasn't there yet. But now when I go back, you see more of it. It's just basically a lag effect with the United States.
Wait a minute. The U.S. will spend about 14% of its $4.3 trillion budget on obesity.
Yeah, so correct. Of that $4.3 trillion, 14% is around $600 billion. So that's how much of the carve out from the medical budget that goes towards obesity. Just on hard cost spending, not productivity loss, just hard dollars.
Wow. Okay. I didn't know any of this. Let's go on.
So now we got these GLP-1 drugs. GLP-1 stands for glucagon peptide receptor agonist.
Very good.
Oh, God. Basically what that does is it slows the rate at which food passes through your digestive system.
Okay.
And it also tricks your mind into thinking that you're full. And we think these are new drugs, but they're not. The first generation of GLP-1 drugs came out in 2005. It was marketed by the name of Byetta, and it was for diabetes only.
Right.
And there was no real weight loss associated with it. And then there's been subsequent iterations of the technology, culminating with the 2022 release of Wegovy and Ozempic. So Wegovy is specifically for weight loss, and Ozempic is for diabetes, although there is some weight loss benefit with Ozempic.
Okay, and these are like, weight loss is not off-label here. It's an approved use so that you can go to your doctor and say, I'm obese, I have a terrible problem, and he will prescribe Ozempic, not for diabetes, but for weight loss specifically.
Wegovy, the answer is yes. So Wegovy is the only one that's currently defined for weight loss.
So we're still off-label with Ozempic, but...
Ozempic is for diabetes, but there is a benefit.
Right.
It's not as aggressive. So typically with Wegovy, you will lose around 26% of your body weight within a year.
Wow, that's pretty good.
It is so effective. The people that go on it start suffering from malnutrition because they just have no appetite. So one of the side effects is they get these gaunt faces and hair loss because they're just so calorically starved.
Now, I'm no doctor, but a drug that causes people to lose their hair and starve sounds like a problem. It sounds like more of a problem than like a way for GDP to get a 2% boost.
I mean, it'll keep you from being obese, which solves a lot of problems that...
So we're talking about an extreme, this is not for like losing a few pounds. This is not for losing 10 or 15
This is not a vanity
pounds.
thing. In fact, there's they call it Wegovy gaunt face because the people that take it, they just get so gaunt and they lose so much weight.
Okay.
So it's not but we're early days. There's gonna be more iterations to tweak this technology. There are currently over 50 new GLP-1 drugs in the pipeline in development right now.
Okay, so that answers my question about competition.
So, yeah, exactly. So right now, Novo Nordisk has a monopoly with this technology. Soon it will be a duopoly. Eli Lilly has a drug, Mounjaro, that is for diabetes, approved for diabetes, in use for diabetes, is under review by the FDA for weight loss, and they expect for that to happen this year. So once that comes into the market, Novo Nordisk will cease to be a monopoly, and it'll become a duopoly.
And so on and so forth. And, we assume that within 5 years, maybe, there will be more than just two.
Well, there will be somewhat of a, no pun intended, a Viagra curve here, where currently this therapy is about between $900 and $1,200 a month. A lot of insurances don't cover it. So, right now, when Viagra came out in 1998, it was $88 a pill. It's now $4 a pill. It's a 95% reduction in price since then. So the economics are so rich and the market is so big, that $900 price point probably will not last very long, especially once these patents roll off.
Right, that's right. More competition, lower
More competition.
prices.
This is currently early days, $2.2 billion in sales. It's expected to hit $40 billion within the next 5 years, and total global addressable market is probably about $100 billion. This is a huge, huge market. It's a huge opportunity. Novo Nordisk is up 48% this year. It's a five-bagger over the past 5 years. Eli Lilly is up 64%, and it's a six-bagger over the past 5 years.
Wow.
This is a huge
Now you
area.
tell me.
Yeah.
Okay. Now you tell me. One thing I wonder about this, it's kind of a philosophical issue. I'm totally full of shit all the time, so philosophical issues are my thing. So we're talking about taking a pill to return to a better state of health, right? This seems like something that could sort of get kind of out of hand. It reminds me, like, I know that this is a dystopian sci-fi sort of a theme that I know has appeared. I remember in Blade Runner, they would show those big, billboards with people taking pills for everything, that you could think of in life. And this sort of makes me wonder. Now, I know obesity is bad. It's bad for you. It causes all the problems we've talked about, 260 odd illnesses associated with it. So you definitely want to get rid of it. You definitely want the benefit economically, of course, because that economic benefit is part of the human health benefit, right? But there's something that just sort of is starting to bother me about this, about taking a pill to lose weight. And when I think of all of the foods that have appeared, all of the sort of unnatural foods that have appeared since the 70s, maybe we're eating a lot of garbage we just shouldn't be eating. And I'm like, well, maybe it makes you want to eat less, but are you still eating the same junk, just less of it? There's a lifestyle thing here that I wonder about.
100%. I mean, what people end up doing is eating less. They eat the same stuff. They just eat less of it.
Fewer calories in.
We're talking sub 500 calories in some cases.
Wow.
So
again, that sounds like it's bad for you.
And like anything else, there's economics is the study of trade-offs, and the consumption that you just mentioned, there will be winners and losers. Apparently, this wonder drug also cuts heart attacks by 20%. Helps with kidney failure. When the tests that were studying the kidney failure issue were announced, the world's largest dialysis company, Fresenius, they're based in Germany, they dropped 24% on that news instantly. So this thing it's a very disruptive technology. Walmart has noticed patterns in its sales associated with these drugs. There's going to be a real big shift in consumption patterns going forward. Whether it's vanity things, sportswear, dating apps. People, when you're not obese, you're more likely to date and engage on these apps.
And I've seen stories about companies like PepsiCo, snack foods, basically, feeling the effects of it somewhat. Seen a story about I forget which airline it was. United.
Correct.
What is it like?
So if the average United passenger lost 10 pounds, the airline would save $80 million a year.
Yeah.
And those results carry over to every single airline on the planet.
Wow. So then what happens? Hopefully the tickets get cheaper because
You'll have a little more room in your middle seat.
Yeah, that's right. Oh boy. Yeah.
But this is really disruptive. I mean, going back to the earlier comment about how just a little under 20% of the U.S. economy is devoted to healthcare, and of that, there's a significant portion that's devoted to the care of obesity and treatment of obesity. Those people that are in that, there are a lot of vested interests that are not going to want to let go, right? People have jobs and built businesses around that whole platform is going to get transformed.
Right. So I interrupted you to get philosophical. If you have more slides,
We can get philosophical. No. But you're right, though. At the same time, we have to get philosophical. This is a public policy question, right? If we're spiraling out of control in terms of health and in terms of the costs associated with that health, and for whatever reason, whether it's people can't manage themselves or our food supply is terrible, or for whatever reason, it's not sustainable. Now 15% of kids under 18 are obese. That's the next generation. That's going to compound way into the future. All those problems that we see currently, they're going to grow as those kids grow. Think about that. So this is a real, aside from an economic issue, it's a real policy issue as well.
Sure.
And does the government, I don't have the answer. And it's a policy choice that people will have, it's a dialogue that we'll have to have as a society. How does the government get involved, and to what degree?
right. Getting back to how you make money off of this.
Why we're all here for.
It sounds like I feel like we missed our chance on
It's early.
Novo and Lilly.
It's early. There's 50 other developers. There's also a whole ecosystem around this. The way these drugs are administered currently, with an EpiPen style type intravenous injection. So there's a manufacturer. I forgot the name of the manufacturer, but that manufacturer is booming. So there's a lot of business associated with this. It's not just the drugs themselves.
Okay. So maybe we go through a period where you move from, monopoly, duopoly, and then there are more of these introduced. And I could see for some period of time, returns on just the drugs continuing to be quite excellent, right? Because correct me if I'm wrong, this is very early days.
Very early, yeah, that's right.
So early days, we missed a 5-bagger and a 6-bagger, but it's cool.
It might be a 10-bagger.
Yeah.
If we're looking at growing this market from $2 billion to $40 billion to $100 billion,
right.
I think there's more in the pipeline. At some point, the insurance companies are going to get involved because the insurance companies have to manage their costs. So look at insurance companies that are starting to take this more seriously. The insurance companies that are putting their heads in the sand and not wanting to get involved with this are going to lose. The ones that face the issue head on, embrace the technology as it is, change their business model around it, will thrive and do better.
Now, you mentioned a minute ago, we were talking about this $900 a month figure, and insurance not paying for it. Some don't.
Some do. I think my understanding is it depends on the state of your health.
Explicitly for weight loss, we're saying they'll pay for diabetes.
Correct.
But explicitly for weight loss, won't.
Say you're obese and you're on your weight. It's a matter of time before you get any one of these parade of horrible diseases, but
right.
Mainly diabetes and high blood pressure and cardiovascular. They will. There's a medical reason, but it's still a fight. I mean, this is not cheap stuff.
Right, it's not cheap, but you have to think about, what's the pain point? Why does the insurance company eventually sort of have to pay?
Well, it either pays $900 a month for the drugs, or it pays for your kidney transplant, or your immobilization, or it pays for your hip replacement because you're obese, now your joints are worn out prematurely. So there's a whole range of factors to consider.
Right.
That govern the economics.
Yeah, obesity swaps, right?
But what's crazy though, this technology is not just, remember I mentioned it tricks you into thinking you're satiated and full. Now they're starting to experiment with addiction. So people that have alcohol cravings, this is currently in the pipeline to treat alcoholism now with the same, they'll modify, it won't be the exact same drug, but it's the same class of drug and they'll modify around it, change a molecule here, tweak it, and boom. Now, if you have addiction issues, you could be administered a drug that will deal with that.
So this is interesting because, forget about alcohol for a second, but there are people who have food addictions who aren't necessarily obese, right? That would be kind of a sticky issue. But assuming other things being equal, I suppose that's the same. But then I would think in the alcohol application, you'd have to be careful with that, right? Because an alcoholic is not necessarily obese.
Correct.
So, I'm not a scientist. I don't know how things are tweaked in the lab, but that sounds like a hell of a tweak to me. If the main outcome is you're losing weight, that sounds interesting to me. That sounds like a hard problem to solve.
Well, here's another dynamic or dimension to it, the time dimension. If you go back and look at other disruptive technologies, whether it's the internet, rail transport, most disruptive technologies really revolve around moving something or someone, whether it's people, goods, products, information. The biggest technological revolutions have occurred around moving something, getting it from point A to point B faster. And if you look at the life cycle of discovery, introduction, adoption, heightened expectations, crash, and then mass adoption, kind of like what the internet went through, right? The internet was really invented by I think it was DARPA, Defense Analyst Research Program. DARPA developed the ARPANET back in the 60s. Then it became an academic tool. And then in the 90s, I was experimenting with email at the library in college. And then you get the browser, and then you get the dot-com boom. But you didn't get mass internet, especially on the mobility side, until the late 2000s.
Right.
So we're going to see a similar type evolution with this class of drugs.
Right. Keeping in mind that we're already kind of 18 years in. They started in 2005.
Well, the good thing is we have the data now. We have a lot of data. Insurance companies they love data. The insurance companies, they know when you're going to die.
Oh, yeah.
They, you tweak an eyebrow, they know that tweak is going to lead to your mortality.
Right.
And the benefit of having that class of drugs come about in 2005 is that we just have all this data.
The man who predicted everything from the rise of inflation to the death of the 60-40 portfolio is stepping forward with the clearest and boldest prediction of his 4-decade career. It all boils down to a single stock, and it has nothing whatsoever to do with artificial intelligence. Former Goldman Sachs trader Dr. David Eifrig believes anybody confused by the current market conditions needs to hear his story immediately. Many of America's best-known investors already bought shares, including Paul Tudor Jones, New York Mets owner Steve Cohen, and Jim Simons, the man the Wall Street Journal named the world's best investor. People in the financial world know Doc Eifrig as the man who went on 3 separate winning streaks of over 100 winning trades in a row. But today, he's zeroing in on just one company and wants to hand you its name and ticker symbol at no cost. In fact, he believes every American should own this company, and soon. To get the full story free of charge, simply go to docprediction2023.com. Again, that's docprediction2023.com.
All right. So do you, founder of Pinebrook Capital, have an allocation based on this idea?
So when I got back from vacation in Copenhagen, I bought some Novo Nordisk, but it was more of it was a small punt just to get my toes wet. I'm still long the position, but I'm looking at it from a macro standpoint. Long term, we've all heard about how our deficit is unsustainable, right? Basically, by 2090, our economics will be, at their current trajectory, will be completely upside down. Right now, we take in around 20% of GDP in receipts, We spend maybe 3% over that. We have a 3% GDP deficit every year, and we have a 100% debt to GDP ratio. Over time, starting around 2032, there's going to be a huge divergence between what the government takes in and what it spends, and it's going to get bonkers.
It seems pretty big now.
This is nothing. There's going to be a 47% point difference between what the government takes in and what it spends, and that affects what? Interest rates.
Oh yeah, rates.
That's
all day long.
That's the macro part. But if the government, right now the government's on a collision course, on a fiscal collision course with reality. The medical situation is also on a similar unsustainable collision course. These drugs sit in the middle of where those two lines meet and have the potential to change those trajectories, whether it's the sustainability of the medical system or the sustainability of our budget deficits. Why? Because if people retire less and they're more productive and they remain in the workforce longer and they don't take Social Security on the first day that they can, that puts that on a different trajectory. I mean, there are so many second, third, fourth, fifth, order effects
Right.
as a result of this paradigm shift.
Right. All the second plus order effects. It sounds like it makes it harder to bet on.
I mean,
I can buy Novo, I can buy Lilly, maybe. And other than that, I'd want to go through every pharma and biotech that is developing right now. And that seems like the next step. I got to know every pharma and every biotech that is, has one of these in trials or whatever stage they're at.
Right.
Got to know that.
So, I mean, all the big brokerage houses, I think, are putting research out. I don't know how much I trust it. I would trust Stansberry a lot more, obviously.
There you go.
But this is a huge ecosystem. I'm still trying to wrap my arms around this. This is very new for me as well.
Right. And United Airlines, apparently. We can buy that one too.
So, I'm sorry, go ahead.
Not that I want to buy an airline ever. So let's look at some of this. You just talked about employment, jobs equivalence, productivity gains, reduced absenteeism. All right. What is R star? What the heck is that?
So R star is this wonky way of saying what's the optimal interest rate that doesn't cause inflation or bleed the economy dry. That's it. It's real simple.
Okay.
And R stars, depending on the level, is typically associated with, kind of a stagnating economy, like Japan for the past 30 years, had very low interest rates. They couldn't debase their currency fast enough, and they were basically suffering from economic stagnation. So,
Right.
We on the other hand didn't have that problem, although we flirted with it prior to the COVID pandemic. But what you want to have is an R star that helps breed innovation, that helps breed sustainable growth. If it's too low, everybody just buys bonds and sits down, and that's what happened in Japan.
This is so weird to me that we're talking about like obesity drugs, and that's normally a reason to buy pharma stocks and not think about much else. But you're talking to me about interest rates in Japan.
This feeds into demographics. It feeds into productivity and growth rates and interest rates. It really, in a funny way, this is kind of the Rosetta Stone that brings all these forces together.
Well, why am I wasting my time thinking about anything else? I mean, I'm thinking about all this other stuff.
Honestly, I think this is bigger than AI. I think AI is going to suffer the way a lot of other hyped up technologies suffer. It'll get promoted, and then there will be some disappointment when it doesn't deliver on the expectation.
Okay, I mean, that would certainly be...
The difference with this, though, is the people that lose weight, they do so within a year. So all these other transformational type technologies that, it's a 30-year bet into the future. This is happening in real time. This is happening now. People lose the weight. They get healthy quick. And that's what I think makes it a lot different than other transformational technologies, is the speed at which it impacts all these things I mentioned. Okay,
so then the next question becomes like, how soon do how many, obese people wind up on these drugs for this purpose? And then, a year later, everything's kind of wonderful. Right? I mean,
there's the obvious, there's the pink elephant in the room for now is the cost. And also, there are, as I said, there are some vested interests that are going to give pushback. People that are currently employed in these jobs, practitioners, people that have built businesses around this. There will be some pushback, but you can't stop I mean, this sounds maybe philosophical, but it's hard to stop. Once the technology is out of the bag, it's hard to keep it in the bag. Whether it's nuclear, whether it's whatever, it's really hard to put technology back in the bag once it's come out.
All right, I keep trying to figure out how I'm going to play this though. Like, tell me about interest rates. Like, am I going to see? Are we going to go back to
So here's a practical way to play it. I mentioned the disruptive factor, right? Fresenius got. They got whacked 24%, right? So identify the companies that are at risk of being disrupted. So if you're a dialysis provider, your time is up soon. If you're, pacemaker manufacturers, all these, this whole ecosystem that revolves around treating these ailments that will soon can go away. Those are the shorts. Those are the ones that at least you don't get involved with.
Right. Well, I know Walmart's the number one seller of diabetes, so they're screwed, right? I mean, I should just short Walmart tomorrow.
Well, I think they have the pharmacies, right? They have pharmacies and they sell.
Yeah, they do
sell drugs,
right? And they sell them for cheaper than anybody else. So
probably.
That's there's going to be a much longer line there than there is. It's going to be like the bakery line is the longer one now, and then all those people are going to be over in the pharmacy line.
The other one too is all the fast food places, right? McDonald's, Taco Bell, all those. Yeah. Those are ripe for disruption.
They are ripe for disruption, and I know. I mean, McDonald's sells burgers all over the world, but they have done a reasonable job over the years of kind of incorporating whatever people want to eat. So I could see them adapting, but they're going to sell a lot less. Or they're going to sell a lot less of that super high margin stuff they sell. Sodas. I mean,
right.
Soda costs them 2 cents, and they sell it for $1.50 or something crazy. Right. So yeah. This reminds me of the moment when everybody was in love with the Nifty 50 almost, because there were things in there that people said would grow forever, and McDonald's was one of them. And it actually did a lot better than some of the other ones, but then along came various technologies and wiped a bunch of them out. And I feel like you're telling me that we're going to see a bunch of things get wiped out now, but I just want to get my pen out and write the list down right now today.
I got to put one together myself. I mean, like I said, I just came across this stuff 2 months ago.
Okay.
But maybe it could be a product for a research publication.
Well, yeah. I mean, I'm sure if we had Dave Lashman up, he would tell us every technical aspect of this and has already looked at it deeply. But right now, I just want to know how long it's going to take for me to, get my 5-bagger. Because it sounds like it's not going to be very long. I mean, it's a serious question, though, because if this works as fast as you say it does, that feels like it doesn't give me a long time to, suss out every biotech and pharma company that might be developing something. And then I got to figure out who's going to succeed there. And then who to avoid. I don't know if I avoid Walmart, but I avoid, maybe DeVita and Coca-Cola. I avoid Coca-Cola. I avoid, obviously, Fresenius and DeVita, right?
Yeah.
I mean, I wonder if Buffett's going to sell DeVita, or I don't know if it's him, but I know one of his guys, maybe Coombs or one of those guys likes it. And they've got a big position in it. I mean, it took a big hit. Those stocks took a big hit recently, like within the past couple of weeks here. In one day, boom.
I mean, was it linked to this? I wouldn't be surprised if it was.
Yeah, it was linked to, the kidney. It's the kidney link.
Got it.
Right?
Yeah,
because they're dialysis providers.
Yeah.
So every headline that comes out, you're going to be like, oh, yeah, this thing has a wide moat. I thought this thing had a wide moat, but there's no more wide moat. I think moats are narrower generally, aren't they?
Well, with technology, sure. I mean, technology is the bridge, and it's got to either bridge them or fill them in.
Right. So when I think of wide moat stocks that everybody kind of loves, I can't help but think of the Magnificent Seven. And I wonder, if this is the just overwhelming macro theme that, you're painting a picture of this affecting every part of life, every part of the economy. or, all the big important parts. It makes me wonder about any effects on the Magnificent Seven, Apple, and which is already not growing so great, and people are still putting...
Apple's going to have report negative 1% revenue growth when they report. So yeah, you're right. They're kind of stuck. Apple's going to be is really a margin story at this point.
Right. So what? Apple, Nvidia, Tesla, Microsoft, Meta Platforms,
Amazon,
Google. I mean, I don't see any direct. I don't find a direct connection in any of these.
The only direct connection I would see is if once this medical ecosystem grows, and it will grow, if investor attention, animal spirits,
right?
If AI does not deliver on its promises,
right,
and this stuff is actually performing as advertised, then I could see investor animal spirits shift their attention to these names to the expense of the Mag 7. I don't think that's a today thing. It's not a this quarter thing, but it could happen.
No, the only today thing I can see is the biotechs and pharmas, and researching the effects on the snack foods, on Pepsi, Coca-Cola. Well, Coca-Cola is an obvious connection.
Gyms.
Yeah. So
sports equipment. I mean, it's amazing how this pervades almost every dimension.
Well, wait a minute. Are we saying people buy sports equipment because they think it's going to help them lose weight, and they won't buy sports equipment?
Either they won't, or they may be encouraged. It really depends on the kind of equipment. If it's something like Peloton, it's a high price point, and if you can get, if you're spending $900 a month on these drugs, you're not going to spend $2,000 or $3,000 on a Peloton machine.
Right. Okay. Well, they're highly cyclical anyway. I don't know. I think I'm satisfied enough that I need to go do a whole lot of work on biotechs and pharmas. I think that'll take me a month or 2 or 3. So, unless you got something else.
I'm just putting my arms around it right now. So it's also a product for me.
And just generally, because this is something I'm interested in, what do you think this does to interest rates in a longer term?
I think if we can manage to tackle this public policy crisis, reverse the unsustainable path that the medical system is on and that the budget deficit is on, it'll keep interest rates from having a supernova event in 20 or 30 years.
Oh, okay. So it'll keep interest rates from soaring out of sight.
Absolutely. When you have to fund your deficit. Yeah.
Right. Yeah. Gotcha. Okay. But that's farther out.
That's not a today thing, correct?
Right. All right. I think I'm pretty satisfied here. I think I just need to. I think these people are now going to be like, tick-tock, Dan. Let's get to work on the farmers.
The cat's out of the bag, and I think we got to go chase it.
Yeah. All right. Well, thanks for being here, and I encourage everyone to follow David on Twitter, Pinebrook Cap.
At Pinebrook Cap.
At Pinebrook Cap on Twitter.
And my website is pinebrookcap.com.
Okay. Sounds good. And, hopefully we'll be talking again soon. Thanks for being here.
Thanks for having me.
You bet.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking